We've spent a lot of the sessions today looking in two areas, global equities and private markets. And I sort of structured it in that way because it seemed to me that for portfolio managers and advisors, those are the two areas of portfolio construction at the moment that must be exercising the greatest degree of their attention. And so it's a pleasure for me to welcome Ari Rajendra to this session. Ari is the head of private market indices for S&P Dow Jones Indices. So it's been his challenge over the last couple of years to think through the way in which you quantify the returns from private market investments, and we're going to talk about the ways in which you measure, assess private markets, both equities and credit, and the uses to which that form of measurement might be put. So, Ari, welcome to the stage.
Thank you, Toby. Thanks for the introduction.
Yeah. So private markets have grown rapidly. We've had a lot of discussion about the growth. I think S&P project them to reach 25 trillion by 2030. And we had a session earlier on which looked at the construction of a private markets SMA, some private equity and private credit. There's a sort of tendency to categorise, all of this area as just private markets, and that seems to me to be too broad. How do you categorise? What does private markets mean for S&P?
Yeah, it's a good question, Toby. So I suppose private markets as an umbrella term may be a little bit blunt, and we are, to your earlier point, just to sort of give a bit of background, the team that I lead, the product team that I lead in private markets, S&P Dow Jones Indices, is relatively new. And so our goal is to essentially build indices in private markets, which what we call as the new age of benchmarks. And so we're in the early stage of benchmarking. So whilst where data is available, we are sort of working our way through the granularity of the segment. But I do get your question. Your question is a taxonomy question. And the way we are looking at it at the moment, you broadly split private markets to private equity, private credit, and real assets. And that you could, I suppose, refer to as a layer one. And the next layer, if you go into private equity, you could split that up to venture, growth, buyouts. And in private credit, for example, you've got corporate lending, you've got asset-backed finance, and opportunistic credit. So again, you can just keep going down. So you are right. I think when we get to the luxury of having all the data and having the classification is necessary to have measuring all these segments individually. So and each of these have obviously different economic outcomes.
Yes, I mean, one of the things which I'm sure, which I've noticed, but which must be frustrating to a number of advisors, is private market products, funds, benchmarked against CPI plus 2 or 3, or RBA plus 2 or 3. These are essentially return objectives rather than asset-linked benchmarks, and I don't think they've provided a good guide to the construction of portfolios. So how you say it's a new area for S&P and a growth area. How are private markets currently measured or benchmarked? Why has it been so difficult to get the data?
Yeah, that's a good question again, and actually, when I describe new age of benchmarks in private markets have been in existence for a number of years, for many years, in fact. And they've been primarily fund-based benchmarks. The approach has been where you've had manager reporting returns, we've had sort of peer group comparisons, and you've had vintage type sort of comparisons. So again, the performance measurement is very different from public markets. Now, whilst this has been useful and still remains useful today from a manager selection perspective and performance reporting, there are some limitations. The limitations is when you look at the valuation frequency, it is lagged. And from a transparency perspective, we're not seeing the asset level characteristics of the asset class. And so that's what we're working towards. Yeah. And so I suppose if I were to summarize, Toby, in terms of what we've had over many years versus where we're getting to, the benchmarks that have been in existence has been it's been sort of focused on the manager standpoint. And where we're getting to is looking at the portfolio aspect, understanding risk. And I suppose what you're describing there is where it's sort of in between. Either you look at public market equivalents with a spread or an absolute return metric.
Yeah, so so if we just drill a little more deeply into that sort of those fund-based benchmarks. So this is where the benchmarks have been effectively the equivalent of peer group indices in the managed fund, in the retail managed fund market.
That's right. Yeah. So I suppose the question is to sort of describe how the fund-based benchmark works. Is that
and what an asset-based benchmark would be in distinction.
Got it. Just maybe just to explain that a bit further. So the way we are actually partners with Cambridge Associates, and Cambridge Associates is a benchmark provider. They've been around for many years. The way in which those benchmarks work is they get contribution of NAVs and cash flows from GPs directly at the fund level. They construct the benchmarks at the fund level. Essentially, it's a collection of of funds within the benchmark. Now, what we are trying to do is trying to drill down into those funds, specifically going back to your earlier question on taxonomy. For example, if we're looking at private equity and we want to focus on buyouts, could we get to the asset level information? And that asset level, and we want to build indices based on that asset level information, which is where we think will make the difference in terms of understanding the portfolios versus.
So this is being able, just as, say, the S&P 200 is built up from the returns of individual companies.
Absolutely.
This is being able to go, okay, if I'm going to have a benchmark for corporate lending, is built up from individual corporate loans.
That's right.
Yeah. That must be hard data to access. I mean, what are the challenges in accessing that sort of what has previously been confidential information? How do you access accurate data, or for what's an opaque area?
Yeah, it's a good question. So again, data is first and foremost quite fragmented at the moment. So data may sit with an asset manager. So there is limited structure to data at the moment. So you may have an asset manager that's sitting on a whole lot of data which is not structured. You may have platforms that may hold data. You may have valuation agents that hold data. So the fragmentation is one aspect. The timeliness of the data is the other aspect. So these in this asset class, typically valuation is on a quarterly basis, and when it gets reported, it's on again, there may be a lag. And finally, in terms of comparability, now given it's fragmented across different asset managers, they all have different styles or standards in terms of how they report, and that standardization is not there. So moving on to how do you solve that in terms of, I suppose this is where we refer to as the ecosystem approach. And what we are doing is we're engaging with various different of these type of entities that we mentioned, and we're bringing that in-house and applying our standards, our methodology, our governance to provide that standardization in the indices.
Yeah, we had some discussion earlier on about sort of delinquency rates within private credit funds, and the potential for managers to roll over unpaid interest to avoid declaring defaults. So that sort of speaks to the valuation issues. I mean, from S&P's perspective, how do you think about the valuation of those underlying assets? I mean, how do you arrive at valuations that you have confidence in to go, right, in aggregate, here's an index based on those values for those underlying assets?
Yeah. First of all, I should highlight that we have a governance committees, index committees that look into the credibility of our indices, and obviously we're a regulated index provider, so we need to ensure the prices that we get are credible enough to feed into the indices, and that's an important aspect. Now, that said, this segment, private markets, is in its nascency in terms of moving into greater transparency. We don't have the luxury of seeing continuous trading, daily pricing that we have in public markets, but I think that's our role. So, for example, if I were to give you some of the partnerships that we've fostered through the ecosystem, for example, we've worked with a company called Nuvas, which is a fund of funds. They have a top 50 private equity top 50 fund, which is very formulaic in nature, but their data structure was not there. So we went into them and said, you need to provide the structure and the standards that we need, and they implemented that over the period of 6 to 7 months, and that is providing the standardization. Now, from a valuation perspective, I suppose there's two different things, and the provider of our data can be audited, put it this way.
Yep.
So they are obliged to have the necessary practice in order to make sure that the prices, or NAVs as it's called in the industry, are accurate as it can be. And obviously the other potential is looking at the overlay of valuation groups that can add credibility to the valuation. But yes, I think there is a direction of travel, and we're moving down that path of greater credibility in valuation.
Now, S&P is a global firm, and obviously there are more assets available in the US and Europe. So this is a two-part question, really. One is, what have you been able to develop for the US and Europe in this area? And then what about Australia? What about us?
Yes, it's a great question, and I would say, as a preface in terms of the data availability, it's very much skewed towards the US at the moment.
Yep.
And again, it's, as I mentioned, we are at a very early stage of this sort of transformative phase, and we are. We need to apply the necessary due diligence when we get data, and it will take time for data to develop across the various different regions. I think we've talked about this in the last few days. Although there's a skew, we see pockets of data, as you mentioned, in Europe. Coming back to Australia, now I don't want to be cautious to be drawing sort of comparisons between the region, but from what I've heard so far, being here in the last few days, the market is certainly forward-looking and developed when it comes to distribution of private markets into the wealth segment. But from a data perspective, I think that's going to be different, and I think we will get there. And at some point, as you can see, we are, what I've just described in our previous question, we are seeing structure coming into the ecosystem per se, and at some point, I think that will reach all regions.
Yeah. So if we do end up, yeah.
Question: where is the incentive as a private credit manager to report in?
So just for the recording, what's the incentive for a private credit manager to report, their underlying assets, to sort of lift the skirts?
Yeah. So I think if I were to comment on that to start with, the observation is it's been a bit divided. It's mixed views between the various different private credit managers. Now, from a private credit manager's standpoint, They are moving from sort of institutional reach or ultra high net worth towards more mass affluent or the wealth, going down the wealth community. Now, as a result of that, and I know we were going to get into fund innovation, you've seen the advent of evergreen funds, and that's being distributed into wealth. And I think one of the things that we keep hearing is transparency from an investor standpoint. I think once you move down the investment sophistication level, there needs to be a bit more simplicity in terms of what are you actually investing in. And I think there's an acknowledgement from the private credit managers that indices can bring that transparency, clarity, and understanding. It's not just a measurement tool, right? It brings that sort of independent framework as to what an investor is investing in. In the same way, I don't think we're not there yet, but in the same way, you see public markets and ETFs, right? So,
if I've got an observation about that, to that point, it's also in the interests of the asset owners, which in Australia is predominantly the industry, predominantly the industry funds, to be able to say to the managers that they are contemplating putting into their portfolios, we want to see you participate in this because we want to have transparent benchmarks that we can rely on, that we can then measure you against. So it may be something that the investment managers are essentially told to participate in. Having said that, in the US, every managed fund reports its holdings every quarter, and we don't have that. We don't even have that yet in Australia. So that sort of regulator pressure might not be there. In the event that we do end up with private market benchmarks that have got integrity and more importantly history, what do you see as the opportunities that new type of benchmark would give rise to?
Yeah, I think I may have already touched on some of the benefits. So, to my earlier comment, an index is not just meant to be a measurement tool. It's there to be a reference point. It's a common framework. And it can also be a framework for product creation. So it can shape product innovation in the future, right? So as we've seen in public markets. Now, from a practical standpoint, this goes back to my earlier comment around what has been available in terms of benchmarks at the fund level versus asset level. We need to, from an allocator standpoint or an advisor standpoint, you need to understand how you compare the asset class within itself and to public markets. And for that, in terms of portfolio construction, better understanding of risk. Again, something we've talked about, a simple measure of volatility. You can't actually accurately do that using fund-based benchmarks. It's not, strictly representative. Yep. You do get a measure, right? So the benefits from a portfolio construction basis, but more broadly, you're bringing more transparency, consistency, and effectively understanding the asset level, the exposures into these indices. Sorry, you're going to.
No. So do you see? We've seen ETFs develop off the back of listed market indices. Do you see the potential for ETFs or other investment products that are benchmark related in this market?
Yeah. So I'll start by saying it may be a bit too early for pure play private markets within an ETF wrapper. That said, there are 2 ETFs, to my knowledge, in the US on private credit, right? But it is a blend of public and private. Now, at present, given the nature of the asset class and the regulatory constraints, depending on the jurisdiction, there is a limit as to how much illiquid assets you can have in an ETF. Now, going back to my earlier comment on evergreen vehicles, I think an observation of respecting the liquidity of the asset class. I think in the nearer term, that may be a more sort of appropriate path for the equivalent, or you could maybe, if I reframe it, you could see that as the ETF for private markets. And you're seeing the development and growth in various different regions. So in the US, they're called interval funds and tender offer funds. In Europe, it's the LTIFs, the long-term incentive funds. In Europe, in UK, it's LTAFs. So I believe there are evergreen structures here as well.
Yeah.
And we could see that the use of indices within these structures first before it gets to ETF. So I think we are a while away.
Right.
From ETF.
So do you want to explain just a little about how an index within those structures would work?
Yes. So we've obviously, in terms of private markets and public market indices, in public market indices, you have the benefit of full transparency into the individual holdings. In private markets, although, like ourselves, we do get asset level information, we may be precluded from showing that asset level information. But what we can do is describe the risk of the index.
Yeah.
So I'll give you an example. So let's take a direct lending index. We can take a direct lending index and split that into EBITDA buckets, or sort of break it down by size, or break it down by sectors, break it down by currency. And within each of those buckets, we can provide description of risk metrics like the loan-to-value ratios, the yield, the maturity. And that, in my personal view, I suppose may represent a framework of risk that the product could originate assets against.
So in a sense, instead of being able to buy the 1,000 underlying loans, they buy a basket of loans which essentially mirrors the risk characteristics of.
And if I could add, the comparison that I would draw is to the ETF world.
Yeah.
If we look at equity ETFs, the tolerance for tracking error is nearly zero because you can track it perfectly.
Yeah.
You can replicate it perfectly. When you go down to fixed income, depending on where you are, from sort of high grade bonds to leveraged loans, it actually varies. There's an acceptance that 1% tracking error is accepted up to even 3-4%. And in the leverage loan space, if you speak to some of the managers that replicate against an index, they actually take this approach of looking at the risk, and they can source loans up to 20% out of samples. So it really builds an extension from. So it already happens in the fixed income world, but I do think private markets is the next level down where perhaps there's an acceptance that tracking error may not be perfect.
And do you think you could ever get to a position like that in the private equity space, where again, there's so much which is deal specific?
Yeah, it's I do think it's easier in private credit because whereas in private equity there may be a bit more idiosyncratic risk. Yeah. But if we get the luxury of having the asset level data and we're able to bucket the segments, I think maybe we could get there.
Yeah. You hypothesize that there'll be if there's a demand for products that look like that, there'll be a supply of probably derivative based products from asset owners who say, yep, well I'll essentially swap my real exposure for a derivative exposure.
Yeah, I think that's maybe an alternative way that you could implement these portfolios. Yeah.
Other questions in the last few minutes for us of this really important area as we get towards trying to build transparency and the sort of standards in private markets that we have come to expect in public.
So I've got a question around BDCs and whether publicly listed BDCs or even ETFs that invest in BDCs.
So Darren Beasley referred to that earlier. For those who don't know, BDC is a business development company. I think a listed vehicle that owns loans?
There's a mix, actually. There are about 170 BDCs out there. I think about 50 or 60 are listed, and the rest are unlisted. So the largest BDC out there, which is BCRED, Blackstone BDC, is actually unlisted. But I'll take your...
Yeah, so the question is, does this play a role somehow in all of this? And does this provide a proxy, perhaps, to those markets?
No, it's a great question. So we've actually had a few launches across private equity and private credit. When we started looking at private credit, our first stop was BDCs. The reason we looked at BDCs is BDCs are SEC, they file with the SEC, so you can actually scrape the data off the SEC filings. So you do have loan level data, and we are still looking to launch that in probably Q2 this year. So we did come across another partner called Lincoln International, and we focused on that because there's a mix of BDCs and loans outside of that. But yes, we do see BDCs being a good use case. In fact, on the listed BDC space, we already have an index that tracks it. But and interestingly, we've had recent conversations with some of our partners on trying to compare the performance of listed BDCs to what you expect private credit to behave. But what you see in listed BDCs is, because it's effectively an equity, they do have equity-like characteristics. And the correlation to the equity is somewhat, I wouldn't say high, but you're looking at the 70% type mark. But I think the reason for that is because you're paying the price for liquidity. But I agree, you do get, the great thing about having the BDC data is we will be able to share asset level information, and we can do the same thing that what I described earlier in terms of bucketing the risk. But it is reliant on what's reported on the SEC.
Yeah. Any other questions?
How does the Lincoln index compare to a BDC index?
So the Lincoln indices, so just to give you a bit of background, we partnered with Lincoln International. Lincoln International are a bank, but they're also a private credit valuation specialist. So they had been running a couple of indices in collaboration with the Chicago Booth University, which we now call the S&P US Senior Debt Index and S&P Europe Senior Debt Index. Now, the reason we pursued this relationship, they've been sitting on this data with good history. Number one, they're valuation specialists, so there's a valuation overlay. So when their processes in terms of valuation, they provide few marks from high, mid, low, and the index effectively represents what's in the middle. Secondly, BDCs are only focused on the US. With the Lincoln indices that we have, it has US and Europe, and it goes outside of the BDC loans. So from a representation perspective, we think it is a good proxy for the direct lending market, but we will continue to build on our solutions.
So look, in summary then, this process of building benchmarks, which sounds dry, seems to me to be just a fundamental part of the democratization of knowledge about investment markets. And as we're seeing from so many of the sessions today, this is becoming just a fundamental part of the way in which particularly high net worth and mass affluent retail investors will have their portfolios constructed. So this is a way of creating a level of knowledge about the way markets perform as a way of measuring and setting expectations for the way managers should perform and the way portfolios should perform. So please join with me in thanking Ari for his time.
Thank you. Pleasure to be here. Thank you.